It's May 5th, 2026, and this is the Commerce Riff brought to you by the CPG Guys. 10 minutes of the news stories that matter in commerce this week. I'm your co-host, PVSB, and I'm joined as always by Papa Raj, the father of pop stars, co-founder of Think Blue Consulting. Sri, we're in Cincinnati today. What's going on?
You know what? With Kroger, doing some recordings, having some nice dinners, and also speaking live at the Ignite CPG Insights and Analytics event, opening keynote.
All right, let's get into it. 4 stories this week, and they'll span the full spectrum. A legacy CPG giant swinging for generational scale. A storied home retailer clawing its way back from the dead. The world's largest retailer opening up its data layer to the advertising ecosystem. And a brand-building powerhouse posting strong numbers even while mid-restructure. Let me kick it off. Kimberly-Clark, momentum, Kenvue, and a $40 billion bet. Because Q1 2026 was a quarter that deserves attention, both for what it delivered for Kimberly-Clark and for what it signals about where this company is headed. Maker of Kleenex and Huggies posted a profit of $665 million, or $2 a share, up from $567 million, or $1.70 a share a year ago. Adjusted the EPS came in at $1.97, ahead of Wall Street's expectations of $1.93. Revenue rose 2.7% to $4.16 billion, topping estimates of $4.09 billion. CEO Mike Hsu called out consumer-inspired innovation, brand love, and strong execution, and noted that share momentum continued to build even amid macroeconomic and geopolitical headwinds. But here's a real headline buried inside these numbers. $0.13 of that $1.97 adjusted EPS came from the pending acquisition of Kenvue. That's right. Tylenol and Listerine maker that J&J spun out a couple of years ago. The $40 billion deal is expected to close in the second half of 2026. Management is already talking about it as a generational value creation opportunity. Think about what that combination looks like. Kimberly-Clark is already one of the most efficient operators in CPG. They've spent years building cost discipline and category leadership in diapers, tissue, and professional hygiene. Now they're layering in Kenvue's OTC health portfolio, Tylenol, Listerine, Band-Aid, Aveeno. That's a dramatically expanded presence at the intersection of household essentials and everyday health. There are risks, of course. Executives noted a potential $50 million to hit the bottom line from Middle East conflict-related cost pressures. That's the Iran war, if no one else understands that. Flagged $150 to $170 million in gross incremental input costs in the second half of the year if oil prices remained elevated. Crucially, those costs are not in the current outlook. So the back half of 2026 will be a real test of how well KC can manage integration complexity alongside commodity headwinds. The CPG lens, Kimberly-Clark is making a bet that scale in health and hygiene is the winning long-term position, and that operating leverage across a unified portfolio can fund through macroeconomic friction. If the Kenvue integration executes cleanly, that would be remembered as one of the most consequential CPG deals of the decade. Watch the shelf reset and watch the shelf space negotiations that follow. Sri?
You know what? I'm going to hold our CPG guys' opinion strong that this merger creates competition for P&G, creates competition for trips, and at the shelf. So here we go. Let's go from earnings releases to an actual restructuring. And it is none other than Unilever, an org that we actually loved on stage at CAGNY. This is a company that's actively mid-transformation, and Q1 26 showed the very early returns on a very deliberate, what I would call a strategic pivot for the company. Underlying sales had gone up by 3.8% year over year in the first quarter, ahead of company compiled analyst estimates of 3.6. So they actually beat it, Peter. Emerging markets led the way, up 5.7%. Home care stood out. Organic sales growth of 6.1%, entirely volume driven. Clap, clap, clap. Latin America delivered 6.2% organic growth, with both volume and price contributing. Full year guidance is for underlying sales at the bottom end of its 4 to 6% multi-year range. So one of the few in the industry still giving growth in volume as a guidance. But the biggest story is the portfolio restructuring happening underneath these results. About a month ago, Unilever struck a deal with McCormick to combine their food businesses into a new company valued at $65 billion, including debt. Unilever shareholders will hold a 65% stake, so roughly two-thirds. The deal has drawn skepticism from European investors who are wary of exposure to leverage US-listed food assets, but consistent with the strategic logic Fernando Fernandez has been executing since he took the boss's chair. The true line, though, Unilever systematically shed its food exposure for several years. If you remember, they spun out Magnum ice cream, one of our personal favorites, which, by the way, reported 4.4% organic sales growth in Q1, beating its own analyst estimates at 2.6%, posting 1.77 billion euros in revenue. They sold off the tea business and divested margarine and spreads, and now by combining the remaining portfolio with McCormick, essentially completing the transformation into beauty, personal care, and home care company. Another behemoth, along with the previous merger we talked about. There's some trifecta competition here. What's the thesis for this? The premium, high engagement consumer categories, skincare, hair care, home hygiene, are more defensible, higher margin at scale. And food, of course, where private label pressure and commodity volatility eat into returns. And I know all that too well through my career at PepsiCo, Frito, and none other than General Mills. Fernandez has replaced significant leadership out of the white-collar workforce and is running a genuine org makeover. Q1 results actually, Peter, suggest it's working, but the McCormick integration is the real POC. For CPG peers and retail media practitioners, Unilever's category prioritization is a live signal about where premium shelf space battles will intensify. Beauty and personal care are already highly competitive in both digital. A more focused Unilever, fewer categories to fund, more resources to deploy, will be a sharper competitor in the aisles in the digital shelf that matter most to it. Now, I would love for you to compare the first story and the second story. Kenvue, Casey, Unilever strengthening McCormick.
At the CPG Guys, we're excited to partner with today's sponsor, Confido. Think about how many different workflows your team is managing right now. Your sales team is planning promotions in a spreadsheet. Your finance team is manually managing deductions from a dozen different retailer portals. Your ops team is building forecasts in a totally separate tool. And when something changes, a promotion shifts, a big deduction comes in, nobody finds out until it's already a problem. Most CPG brands are running these processes in silos, and the cost isn't just time. It's the decisions that don't get made or get made on bad information. Confido is the end-to-end platform for CPG operations built specifically for brands to run all of it in one place. Trade promotion management, deductions, disputes, sales forecasting, demand planning, and retail analytics. When your trade events are connected to your forecasts and your deductions are automatically matched to your promotions, your whole team is finally working from the same picture. Over 200 CPG brands, including Olipop, Bear Bells, and Simple Mills, already use it. Go to confidotech.com/CPG Guys to learn more. That's confidotech.com/CPG Guys. Absolutely, Sri. All right. Walmart Data Ventures just made a move that changes the architecture of how retail media planning and measurement work at Walmart. They've introduced Scintilla Media Data Feed, a new API-based product that allows advertisers to share Walmart's first-party operational and retail data with their agency and technology partners. We're talking approximately 500 operational and retail data elements: digital transactability, item attributes, omnichannel sales, inventory signals, the whole shebang, Sri, all flowing directly to partners' platforms of choice via scalable API access. What problem does this solve? Well, until now, media teams and tech partners were operating with an incomplete picture. They had slices of advertiser data, but not the full operational and retail context needed to connect media decisions to retail outcomes. Planning happened in one silo. Optimization happened in another. Measurement came later, separately. Scintilla Media Data Feed collapses those silos by giving partners, agencies, DSPs, measurement vendors a real-time shared view of omni-channel business performance. The results that Walmart is already citing are quite compelling. A leading CPG brand used Scintilla data to identify competitive share loss at the zip code level, markets with untapped potential that had been invisible in their media data strategy. They ran a geo-targeted offsite campaign through Walmart DSP, targeting competitive buyers. The outcome? A 2.97% sales lift across targeted markets. That's 2.1 million households reached, with more than 18 times higher impression delivery than those markets. A 72% win-back rate among returning buyers and 31% new buyer acquisition. Wow. That's not a test and learn result. That's a proof of concept. I want to flag something personally meaningful here. Flywheel's own Bernie Chase, Senior Director of Retail Acceleration, a friend of mine, is quoted in the Walmart announcement. Her observation that item-level performance visibility is what lets you identify where incremental ads investment will drive outsized return is exactly right. This is the kind of closed-loop, retail-first media thinking that Flywheel has been building towards. The broader signal, Walmart is not ceding the data layer to Amazon. They are building an open structure API-driven ecosystem that treats their first-party data as infrastructure for the entire supplier and agency community. That's a significant strategic move. For anyone managing Walmart media budgets, the question shifts from how do we measure to what do we activate now that we can actually Sri. Pretty big, right, Sri?
Scintilla, data powerhouse. We knew these days were coming. The most important thing, my takeaway is from here, competing with Amazon, getting closer and closer and closer and closer to being that, in addition to loyalty building, knowing the consumer, making data available for their vendors to be able to utilize and understand how to do better in an already scaled ecosystem. So you got to watch this one closely. All right, let's move from that to new media powerhouse in the house, and it's none other than the internet's town square, Reddit. Q1 2026, here's what they're saying. Let's close the week on a story that should be a required reading for every CPG brand manager and retail media strategist in our audience. Reddit just posted a quarter that demands your attention and your media budget. The Q1 26 revenue of $663 million, up 69% year over year, 8.5% ahead of the $600 million Wall Street consensus. GAAP EPS came in at $1.01 against a consensus estimated around 58 cents. That's a 79% beat. Wowza. Adjusted EBITDA hit $266 million, representing a 40% margin, up nearly 1,100 basis points year over year. Operating cash flow expanded 145% to $312 million. Crucially, Q2 guidance of $715 to $725 million also came in above consensus. Of course, what happens when all that happens? Shares jumped 9% in extended trading. Let's break down what's actually driving this. Advertising is the engine. Ad revenue grew 74% year over year to $625 million. Performance advertising, kind designed to drive measurable actions like purchases, signups, now represent more than 60% of ad revenue. That is not a brand awareness story. That's a conversion story, and Reddit is increasingly competing on the same accountability metrics as search and programmatic. And apparently, winning. Okay. On the user side, Reddit now counts 126.8 million global active daily users. Unique, by the way, up 17% year over year. US daily actives, 53.5 million, up 7%. International up 26%. And average revenue per user globally, $5.23, up 44%. US ARPU reached $9.63, up 54%, well ahead of the 8.53 Wall Street had projected. CEO Steve Huffman says the goal is to reach 100 million daily US users, though he stopped short of putting a timeline on it. Another revenue line is really worth watching: data licensing, primarily AI partnerships. Companies like Google and OpenAI bought in $39 million, up 15%. This is Reddit's monetizing something genuinely unique, and we need to watch it. 25 billion posts and comments representing decades of authentic human conversation organized by interest and community. There is no platform that has that asset at that depth. Huckman made a pointed observation in the call with the earnings Wall Street. Reddit's capex for the quarter was $1 million, while the 5 major hyperscalers are collectively spending $650 billion on AI infrastructure in 2026. Reddit's position is that it benefits from the AI build-out without having to fund a dollar of it. That's an extraordinary economic position to be in. But what does that mean for CPG? We care a lot about that. Few things. First, Reddit's performance advertising trajectory means it's no longer a test and learn line in your media plan. It's becoming a conversion channel with measurable accountability. CPG brands that are still trading as purely organic or community management territory are leaving money on the table. Second, Reddit communities are where consumers go for unfiltered product research. Ingredient question, brand comparisons, reviews that no brand controls, and in the post-AI world, Peter and I predict it'll still have its strength. Your brand already has a Reddit presence, whether you're managing it or not. The question is whether you're resourced to listen and whether you're responding. Third, as Reddit's data licensing business grows, its data and consumer intent and product discussion is increasingly flowing into AI training sets. We already know that today, which means Reddit is shaping what AI models know about brands and products. That, my friends, is a geo implication that most CPG organizations forget about reckoning with, haven't even thought about. Reddit is not their favorite platform, and that's a problem. Seventh consecutive quarter for of 60+% revenue growth. At some point, the law of large numbers shows that curve, but right now the platform is executing at a level that puts in rare company amongst scale digital media properties. If you don't have a Reddit strategy in 26, you're already behind. Peter, red flag for the CPG guys. We need to be on Reddit, don't we?
Yeah, Sri, their big splash at Cannes Lions last year seems to be really paying off. That's a wrap on this week's Commerce Riff. A reminder to check out our recent conversations with Chris Grillo of Tubi and Caitlin Windsor of PepsiCo. If anything we covered this week sparks a thought, drop in the comments. We read every one. And if you're not following us on LinkedIn, Instagram, TikTok, Facebook, and YouTube yet, well, now's the time. We'll see you next week. The content in this podcast episode is provided for general informational purposes only. By listening to our episode, you understand that no information contained in this episode should be construed as advice from CPG Guys LLC or the individual author, hosts, or guests, nor is it intended to be a substitute for research on any subject matter. Reference to any specific product or entity does not constitute an endorsement or recommendation by CPG Guys LLC. The views expressed by guests are their own, and their appearance on the program does not imply an endorsement of them or any entity they represent. The views expressed by CPG Guys LLC do not represent the views of their employers or the entity they represent. CPG Guys LLC expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, or inability to use this podcast or the information we present in this podcast.